Welcome to Tech Money Madness Weekend Edition, your bite-sized investor education series. Today's topic, risk tolerance. Know thyself before you buy.
Yeah, it's a big one today.
It really is. I mean, imagine for a second that I just hand you a briefcase with $1 million in cash right now.
I would gladly take it.
Right. It is entirely yours. But before you can walk away, I offer you a gamble. We flip a coin. If it lands on heads, I double the money to $2 million.
Okay.
But if it lands on tails, I take the briefcase back and you leave with absolutely nothing. So would you take that flip?
Oh, man. I
Yeah.
mean, mathematically, maybe, but emotionally, probably not.
Exactly. Why is it that, like, a multi-billionaire might take that bet without breaking a sweat, but you or I would probably clutch that briefcase to our chests and just run for the exit?
It's a profound question, honestly. And the answer has, well, very little to do with intelligence and really everything to do with the hidden architecture of human psychology.
And that question is the beating heart of today's deep dive. Our mission today is to translate the dense psychological and highly mathematical concepts behind how we handle investment risk into practical, everyday aha moments for you.
Yeah, because it gets complicated fast.
It does. We are drawing from some of the best foundational resources out there, the CFA Institute, Investopedia, and Wikipedia, to figure out what is actually going on in your brain and your portfolio when money is on the line. Okay, let's unpack this.
Let's go.
Before we can even begin to measure your personal risk profile, we have to define what risk tolerance actually is. And honestly, I always thought risk tolerance was just, a fancy way of saying how much money can I afford to lose.
Right, and that is exactly where most people get tripped up right at the starting line.
Really?
Yeah, we throw the word risk around constantly in finance, but we rarely categorize it. What you just described, how much you can afford to lose, is not risk tolerance at all. That is risk capacity.
Wait, really? Because those two terms sound entirely interchangeable to me.
They sound similar, but they operate in completely different dimensions of your financial life. Let's start with risk capacity.
Okay, lay it on me.
According to Investopedia and the CFA Institute, risk capacity is the cold, hard math of your financial reality. It is the literal financial cushion you have before a loss derails your essential life goals.
So it's about external variables.
Exactly. Your capacity is determined by things like your time horizon until retirement, your income stability, your liabilities, your emergency fund.
Oh, I see.
If your portfolio drops by 30% tomorrow, can you still pay your mortgage? Will you still be able to retire when you planned? If the answer is no, your risk capacity is mathematically low. It just doesn't matter how brave you feel.
Okay, so capacity is the spreadsheet.
Precisely. Capacity is the spreadsheet. Risk tolerance, on the other hand, is the psychology.
The emotional side.
Right. It is defined as your emotional ability to withstand potential losses and market volatility. It's the stomach churning factor.
Yeah, nobody likes that feeling.
No, they don't. It's whether that 30% drop causes you to lose sleep, panic, and sell all your assets at the absolute bottom of the market. It's your literal emotional endurance.
Let me see if I can visualize this. It sounds like risk capacity is the size of your car's fuel tank, but risk tolerance is how fast you are emotionally willing to drive without getting a panic attack.
Oh, that is a phenomenal way to look at it. The vehicle is capable, but the driver is the limiting factor.
Right. You might have a massive gas tank, like a huge risk capacity, maybe millions in the bank. But if you are absolutely terrified of the highway, you're still going to drive 40 in the slow lane.
Exactly. And if we take that analogy to its logical conclusion, if you're a highly risk-averse driver, you're going to pick the route with the fewest unknown variables.
Meaning you'll take the local roads.
Yeah, you'll take the well-paved local roads with clear speed limits and lots of stoplights, even if it mathematically takes twice as long to get to your destination.
Okay, but let me play devil's advocate for a second and push back on this. Shouldn't my financial goals dictate my route?
How do you mean?
Like, if my goal is to reach $1 million for retirement, shouldn't I just build a portfolio that statistically gets me there, regardless of my feelings? Why cater to my own emotional weakness?
Because if you don't cater to your emotional reality, you will inevitably self-destruct.
Self-destruct? That sounds a bit dramatic.
It sounds dramatic, but it happens every single time we have a recession. As Wikipedia outlines in its breakdown of risk aversion, an investor who is highly risk-averse inherently prefers outcomes with low uncertainty.
Right.
If an advisor ignores that and puts that person into an aggressive, high-volatility portfolio just because the spreadsheet says they need the growth, what happens during the first market crash?
They panic.
They panic They cannot endure the pain of watching their net worth plummet. The psychological pressure just breaks them.
So they sell.
Yeah, they log into their brokerage account, they hit sell, and they turn a temporary paper loss into a permanent, devastating reality. The math of an aggressive portfolio only works if you actually stay in the market.
So they are essentially forced to pay a premium in the form of lower expected returns from safer assets just to buy the peace of mind required to stay invested at all.
Exactly. You're trading potential upside for behavioral survival. But getting this balance wrong in the other direction is dangerous too.
Like playing it too safe.
Yeah. If you drive 40 in the slow lane for your entire life when your car was built for the Autobahn, you miss out on the compounding returns necessary to reach your destination. You might sleep well at night, but you risk outliving your money in 30 years.
Wow. Yeah.
What's fascinating here is how this purely emotional, psychological metric, how much you sweat when you look at a red line on a chart, ultimately dictates the hard numbers of an optimal asset allocation.
Which brings up a very natural, almost frustrating contradiction.
What's that?
Well, if risk tolerance is this messy, deeply human emotion tied up in our psychology, our fears, our childhood money habits, how do financial advisors turn that into a concrete number to build a portfolio?
It's tough.
I mean, you can't just hand a client a pie chart and say, well, you seem a bit jittery today, so here are some municipal bonds.
You really can't. And historically, the industry has really struggled to quantify this accurately.
Right.
The baseline tools that most advisors start with are exactly what you'd expect.
Questionnaires and interviews.
Right. They ask you hypothetical questions about how you would react if your portfolio dropped 20% in a single month. They also heavily weigh your time horizon.
That makes sense.
As the CFA Institute notes, someone nearing retirement naturally has entirely different needs and a lower risk capacity, which influences tolerance, than a 25-year-old who has 4 decades to recover from a market crash.
Right, the 25-year-old has time on their side. But questionnaires feel so, I don't know, surface level.
They are.
And here's where it gets really interesting, because the CFA Institute doesn't just stop at asking you how you feel on a scale of 1 to 5. They actually have mathematical models to measure human fear.
They do.
I was reading about something called the Aeroprat measure of absolute risk aversion.
Yes, the Aeroprat measure. It is a brilliant foundational piece of economic theory. It was developed to mathematically quantify an individual's aversion to risk.
Okay.
But to understand how it works, we first have to understand a concept called a utility function. In economics, utility is basically a measure of the satisfaction or the value that you get from wealth.
This is basically happiness.
Exactly.
Yeah.
We represent this mathematically as a function, U of C, where U is the utility or happiness, and C stands for your wealth or consumption.
Okay, so U is the joy and C is the cash. Makes sense.
Right. Now, the Aeroprat formula itself is calculated using the derivatives of that utility function. Specifically, it is formulated as A of C equals the negative of the second derivative of the utility function divided by the first derivative of the wealth.
Whoa, hold on. Stop right there. You just dropped second derivative into a finance conversation, and my brain just hit the brakes hard.
Fair enough. Fair enough.
You have to break that down for me. What does calculus and derivatives have to do with my wallet?
I completely understand. Let's take the calculus out of it for a moment and just look at human nature.
Please do.
Imagine you haven't eaten all day, and I give you a slice of your favorite pizza. How much utility or happiness does that first slice bring you?
Massive happiness. It's the best thing in the world.
Exactly. Now, I give you a second slice. Still great,
Yep.
but maybe slightly less life-changing than the first one, right?
Yeah, I'm getting a bit full.
Right. Now, imagine I give you the 10th slice of pizza.
I don't want it. It might actually make me feel worse.
That is the core concept of marginal utility. The first dollar you earn brings you immense value. It buys you food, shelter, survival.
The first slice of pizza.
Exactly. But if you already have $5 million, finding an extra $20 bill on the sidewalk barely registers in your brain. Your total wealth, your total happiness might still be going up, but the speed at which it goes up is shrinking.
Okay, I am tracking with you. The thrill shrinks the richer you get.
Precisely. And that is exactly what the derivatives are measuring. The first derivative, the bottom part of the Aeroprat equation, is essentially your speed of happiness. It measures how much joy one additional dollar brings you.
Okay.
For almost everyone, that number is positive because more money is generally good. But the second derivative, the top part of the equation, measures how that speed is changing. It is your acceleration.
And because of the pizza slice effect, the acceleration is slowing down.
Yes. Because of diminishing returns, your acceleration of happiness is actually slowing down. Therefore, the second derivative is negative.
So the math is literally just describing the fact that we get used to having money.
Yes. Arrow and Pratt devised this formula to capture that very human dynamic perfectly. Let's make it incredibly concrete with a specific utility function.
Okay, alrighty.
Suppose an investor's utility function is modeled by natural logarithms, which naturally curve and flatten out over time. The function is u of c equals alpha plus beta times the natural log of c.
Okay, U of C equals alpha plus beta ln C.
Right. Alpha and beta are just constants that shape the specific curve for an individual, and the natural log of c is just the math applied to their wealth.
And a natural log curve is perfect because it starts off really steep, meaning low wealth gains bring high joy, and then it slowly flattens out as wealth gets higher, just like the pizza.
Spot on. Now, if we do the calculus on that natural log function, the first derivative, that marginal utility, works out to beta divided by c.
Beta divided by C. Got it.
Notice that as your wealth, c, gets bigger, the denominator gets bigger, so the overall fraction gets smaller. The second derivative, the acceleration, works out to negative beta divided by c squared.
Okay, I see it. The negative sign proves that the acceleration is dropping.
Exactly. Now, we just plug those two results back into the Arrow-Pratt formula. Remember, it's the negative of the second derivative divided by the first derivative.
Okay, so the negatives cancel out.
Yes. The negative of negative beta over c squared becomes a positive beta over c squared. We divide that entire thing by the first derivative, beta over c.
And the betas cancel out.
They cancel out entirely. One of the c's cancels out. And what we are left with is a beautifully simple, elegant, undeniable result. A of c equals 1 divided by c.
Okay, the math is clearing up, but translate that final result for me. Why is 1 over C such a big deal?
Because A of c is your absolute risk aversion and c is your wealth. If your wealth is a very small number, dividing 1 by a small number gives you a massive result. Your absolute risk aversion is huge.
Oh, wow.
But if your wealth is a massive number, like if you are a billionaire, dividing 1 by a billion gives you an incredibly tiny number, your absolute risk aversion approaches 0.
Wow. That right there is the absolute aha moment, because it mathematically proves the answer to the hook of this entire deep dive, the briefcase and the coin flip.
It does.
It perfectly explains why risking $1 million is absolutely terrifying if your total net worth is $50,000. But a billionaire, $1 million to them is just a rounding error. They take the coin flip every single time.
It scales perfectly. The math mirrors the lived human experience. It gives financial professionals a framework to understand that risk isn't just an abstract personality trait. It is heavily influenced by a function of your current resources.
Okay, the math is beautiful, I will admit that. But I know myself, and I am not a beautiful math equation when I'm panicked.
None of us are.
Human beings are messy. So how does a pristine formula survive an actual terrifying market crash? Let's transition into the real world and talk about the common pitfalls and misconceptions when we try to measure this stuff.
The first major pitfall brings us right back to those baseline tools we discussed earlier, the questionnaires.
Right.
Relying solely on standard questionnaires is a massive mistake. A lot of robo-advisors or brokerages will have you check 5 boxes when you open an account. Like on a scale of 1 to 10, how comfortable are you with a sudden drop in value?
I filled those out before. They're so basic.
The problem is, these questionnaires are notoriously terrible at capturing reality, largely due to something behavioral economists call the hot-cold empathy gap.
The hot-cold empathy gap. What is that?
It is the human inability to predict how we will behave in an emotional hot state when we are currently in a calm, cold state.
Oh, I see where this is going.
Right. When you are sitting in your living room on a sunny Tuesday afternoon with a cup of coffee filling out a risk questionnaire, you are in a cold state. You feel rational. You think, sure, a 20% drop is just a buying opportunity.
Of course, buy the dip.
Buy the dip. But when a global pandemic hits, the news is screaming about a depression, and your retirement account has vaporized a decade of savings in 3 weeks, you are in a hot state. Panic takes over.
It's like passing a written test on a flight simulator and thinking you're perfectly calm, but then you're in a real plane at 30,000 feet and the engine actually catches fire.
That is a phenomenal analogy. You cannot simulate the visceral terror of the engine actually being on fire.
Yeah.
And this empathy gap is compounded by another psychological principle called loss aversion.
Loss of it.
Yeah, researchers like Kahneman and Tversky proved that the psychological pain of losing $100 is roughly twice as intense as the joy of gaining $100. Questionnaires almost never accurately capture that asymmetry of pain.
Which means everyone thinks they have an iron stomach until they actually get seasick.
Exactly. And that leads directly into the second and perhaps most dangerous misconception, the fixed fallacy.
This is the idea that your risk tolerance is permanently baked into your DNA, right? Like an astrological sign for money. I'm a Taurus, so I buy index funds.
Precisely. The assumption that once you are categorized as a moderate or aggressive investor by a questionnaire, that is your label for the rest of your life.
Right.
The CFA Institute explicitly warns against this. Your risk tolerance is not a permanent static trait. It is a living, breathing metric that has to evolve because your financial goals, your liabilities, and your life situations are constantly shifting.
So if we look at the listener right now, what does this actually mean for their daily life? Does a single life event like getting a promotion or having a kid require a complete recalculation of their entire portfolio?
If we connect this to the bigger picture, yes, in a practical sense, it absolutely does.
Hmm.
You don't necessarily sit down and do the calculus of the Aeroprap measure on a napkin, but you must recognize that your underlying variables have fundamentally changed.
Like having a child.
Having a child suddenly introduces massive new long-term financial liabilities that fundamentally lowers your risk capacity, which in turn puts immense psychological pressure on your risk tolerance.
Because now it's not just your retirement on the line, it's your kid's college fund.
Exactly. Conversely, a sudden inheritance might massively increase your wealth. As we learned from the 1/C formula, shifting further along that wealth curve naturally lowers your absolute risk aversion.
You can suddenly afford to take more aggressive positions.
Yes, this is exactly why investors must regularly review and update their profiles. Asset allocation is a highly dynamic process.
Treating your risk profile as a one-time personality test instead of a living, breathing financial metric feels like the #1 reason smart people go broke during
It
recessions.
really is.
You don't just set the autopilot on a ship when you leave the harbor and go to sleep. You have to constantly adjust for the wind, the currents, and the weight of your cargo.
That is the perfect way to frame it.
So, to bring all these psychological and mathematical concepts together, let's distill the most vital takeaways for everyone listening right now who might be evaluating their own investment journey.
The absolute primary takeaway is that deeply understanding your personal risk tolerance is the bedrock of optimal asset allocation. You cannot build a durable, lifelong portfolio without first honestly assessing your emotional endurance.
Know thyself.
Know thyself.
Hmm.
Second, you must clearly separate your tolerance from your capacity. Just because you have the math and the money to survive a loss doesn't mean you have the psychological constitution to endure it without panicking.
Yes.
Finally, keep that assessment updated. Acknowledge that your tolerance will evolve over time as your wealth and life circumstances change. Doing this allows you to maintain a well-diversified portfolio that minimizes unnecessary losses and keeps you firmly on track for your long-term goals.
That is incredibly empowering. If you want to explore these concepts further, and you definitely should, I highly recommend checking out the resources from the CFA Institute and Investopedia.
They're great.
They have fantastic, comprehensive deep dives into everything we discussed today, including the step-by-step breakdowns of the Aeroprap measure and the behavioral psychology behind loss aversion.
And I'll leave you with one final, slightly provocative thought to mull over based on what we've unpacked today.
Oh, I love these.
If the Aeroprap math definitively proves that our emotional risk tolerance shifts and our absolute risk aversion decreases as our wealth grows, do sudden financial windfalls make us inherently more reckless or just more economically rational?
Oh, I love that. Does having more money make you brave, or does it just make the math easier? Something to deeply think about the next time you log in to check your portfolio. That's all for this weekend's deep dive. Come back tomorrow for more investor education and weekdays for daily market coverage. Like, subscribe, and we'll see you next time on Tech Money Madness.